But first, U.S. Treasuries rose the most in 2 weeks. As Fed Chairman Ben Bernanke said, there are signs the economy is stabilizing. Still, our next guest likes corporate floaters over Treasuries. Well, with us for more from Sydney is Kumar Palghat, the managing director at Kapstream Capital, Australia's biggest fixed income hedge fund, planning to raise $1.2 billion by the end of the year. And Kumar previously worked with PIMCO. Good to have you with us, Kumar. So your reaction to Ben Bernanke's comments, is it good or bad for bonds in the long run? What do you make of it?
No, I think, look, in the short run, Kathy, I think it's good for bonds because the market just perceived the Fed's not going to do anything. They're going to stay on hold because Bernanke himself said that he's not sure if the economic recovery here is going to be as robust as people think it's going to be. You're going to bump along, so he's not going to raise rates. So if he's not going to raise rates, the market thinks they're not going to raise rates, and they're going to rally a little bit. But in the long run, the amount of money and the stimulus that the Fed has put, he's already talking about exit strategy means only one thing. Rates have to rise from where they are today. The government can't fund itself at 3.5% from here on forever.
So until the Fed does start raising rates, you're not going to be in Treasuries just yet. Is that correct?
I'm not going to be in Treasuries even now. If you look at the markets today and look at the markets for the last 6 months, Treasuries have already sold off. Treasuries have sold off because equity markets have rallied. You're seeing green shoots everywhere. Supply is quite large. So the market is well ahead of the Fed. It's taken back quite a bit of the rate cuts and low rates. So the market's already starting to price in higher rates in the future. So I don't think I'm going to own Treasuries here, even if the market rallies.
But you do own those corporate floaters. But what are you referring to? Because I know that about 60 to 70% of your fund is invested in corporate debt like Pfizer, Philip Morris, and H&R Block.
Yeah, we own quite a bit of corporate floaters because we really think the corporate market is where the returns are going to come from. The reason we own floaters is because we're worried about rising interest rates. Granted, we may not be right for the next 6 to 12 months, but eventually we think rates will rise. So in the last year, in 2008, our funds did positive returns because we own fixed-rate assets. And you buy fixed-rate assets when yields are 6, 7, 8% and the Fed is cutting rates. When the Fed is done cutting rates, you don't want to own fixed-rate assets and you don't want that duration. You'd rather lend to fixed-rate borrowers when rates are higher from where they are. So we'd rather take the floating-rate assets because we think rates will rise.
Kumar, we got to get to this live shot now of the total solar eclipse as we're seeing it in progress from India to China. We are seeing live pictures out of Chongqing in China. What I can tell you from where I'm seated, the sun has practically gone out over the harbor there, and we're seeing a total solar eclipse in Chongqing in China. It is going to be a total solar eclipse over in Shanghai. That's going to be happening for 5 minutes at 9:39 p.m. local time. That's in about 25 minutes. What you're seeing now is going to happen in Shanghai, China's wealthiest city, in about 25 minutes. A lot going on here. It is a once-in-a-lifetime event. You're going to see this again in about 12 decades, but I don't think we're going to live that long to see it. So look at the edge of the sun and the moon creeping right in front of that sun. That's why we're getting that live shot, a very beautiful picture of a total solar eclipse we're seeing in China. Well, Kumar, getting back to the discussion here and a bit about the superstitious beliefs in the eclipse, I wanted to get back to what your clients say about those Chinese clients. I mean, you must have Chinese clients who are a little bit on the superstitious side, and they think that it's really bad to invest in the markets at a time like this when something inauspicious is probably happening up there in the heavens.
Well, to be honest with you, Kathy, I don't think I don't have any Chinese clients. All my clients are Australian clients. Let's hope that other cultures, eclipses are quite interesting phenomenon. Like you said, we probably won't see it at least in our lifetime. Let's hope it's a new beginning in global financial markets for all of us.
I hope so, too. It's really pretty, isn't it? As you can see, those live pictures out of Chongqing in China, a total solar eclipse that we're seeing happening right before our eyes. Let's talk about that fixed interest in Australia that you're seeing now. I know that it's quite high, and your core fixed income money managers did quite poorly last year. You're expecting core managers in fixed income to provide poor returns again. Why is that?
Well, I think the core fixed income fund managers returned poorly last year because they couldn't really save you when the equity markets went down because they owned spread products. They had levered up. They bought collateralized debt obligations, CDOs, CLOs, etc. And those things all blew up in the crisis. So they had levered up at the wrong period of time. Now, again, I think those things are sort of getting sorted out and corporate markets starting to come back in. But this time, core fixed income managers will underperform because they're all hugging a benchmark, which has got 5 or 6 years worth of duration. And as rates rise, every 1% rise in rates, you're going to lose 5 or 6% in capital loss. So you might earn a coupon income, but net rates rising is not good for long-duration fund managers. So I think you're going to get another round of zero returns or very low returns from fixed income fund managers, and you're going to see this all over again, this time from the duration side rather than from the credit side of things.
Yeah, but that didn't quite happen to you, because when you look at the absolute return income fund, it returned over 7.3% last year compared to the average 10.9% loss by the Aussie fixed income fund. Now, how did you manage to beat that downturn?
Well, like I said, last year we were long duration because we thought rates were going to come down. This year our fund is pretty close to zero duration, actually trying to get to negative duration, which says that we don't really like Treasury rates. We really think that rates at some point will rise from where they are. We might be a little bit early in our call because, as Bernanke said, he's not going to do anything on rates, but we really don't like long-term rates. So compared to a core manager, we're close to cash or even negative duration, whereas a core manager's got 5 years worth of duration. So think of a core manager managing assets with maturities of assets that are about 5 years. You'd rather lock in your rates when rates get a lot higher than when they're lower, right? So you'd rather lend to the U.S. government at 7%, not at 3.5%. So that's why we're short, and that's why our fund did well compared to other funds.
Great. Sounds good. Hope you get those Chinese clients into your fund soon, as soon as you grow that fund that you're hoping for. Thank you so much for joining us, Kumar.